It finally happened. After months of expecting it, Bell has decided to cut its dividends by over 56% in their latest earnings report, which happened after months of financial uncertainty. But is this company still interesting for the investors to invest in it, knowing that it currently offers over 5% of quarterly dividends and that it has been able to outperform the analyst expectations in their latest earnings report? This is what you'll be discovering in this video, where I'll make a full stock analysis on the company Bell with the ticker BCE. To do so, as always, we'll first start by taking a look at what is the business model and the latest news that have impacted the company to see how they are able to generate their income. And then we'll make a quick fundamental analysis followed by price prediction with multiple valuation models to determine what is the true intrinsic value of this company. Bell is currently amongst the 3 largest Canadian telecom companies alongside Rogers and TELUS, where all of these companies each own over 30% of the total Canadian telecom market. So it is fair to say that this market is pretty much a triopoly over here in Canada. With no surprise, Bell, as for most of their big competitors, is generating the biggest part of their total earnings from their Bell Communication and Technology Services branch, composed of Wi-Fi, phone and computer services and products. In the first quarter of 2025, this branch only by itself has been able to generate over $5.2 billion of revenue, which is however a slight decrease of about 2.4% year over year. The other big subsidiary of Bell is their Bell Media business, which includes all different types of radio, television, and broadcast stations such as Nuvo, CTV, TSN, RDS, and Crave. On that side, this branch accounts for $775 million of revenue in the past quarter, which represents an increase of 6.9% year over year. This has made that in total, for the Q1, Bell has been able to generate some revenue of $5.93 billion, a slight diminution compared to the same period last year, but by being able to significantly decrease their total expenses, notably the fees that are related to the total debt that have been dropping massively, this has helped them to greatly increase by close to 50% year over year their net earnings, while their adjusted EBITDA have remained pretty stable. And when it comes to the cash flow from the operation, so the cash flow that are generated from the business activities of this company, we can see that they've been able to increase by over 38% year over year, which has greatly helped their total free cash flow. Globally, we can see that the performance of Bell in their latest earnings report has been quite fair, where they've also announced that they were decided to invest more into expanding the scope of their 5G network and 5G network in the US through Zipline Fiber. In fact, they've announced a fiber JV that aims to ramp up the development of fiber infrastructure through Zipline Fiber to underserved markets in the US. This will be great for Bell because it will help them to generate more income outside of the Canadian market. But in that case, why does this company recently decided to cut its dividend, and why has it been on a certain important downtrend momentum over the past couple of months? First, there was a CRTC decision that was taken back in 2023 with the objective to aim at improving the telecommunication affordability and access for Canadians. This decision was based on promoting more competition, ensuring universal access, and providing more affordable options for consumers, which also means to control the price of the different Canadian telecom companies. And so the ripple effect of it has been well felt by all the big Canadian telecom companies that has lost quite a lot of their total valuation over the past couple of months and years. Indeed, when we know that the different Canadian telecom companies are usually companies that have a lot of debt because they are investing massively into their infrastructure to expand the scope of their different fiber and 5G networks, and because these companies usually pay some super high dividends to their different shareholders, this has had the impact to put companies such as Bell into high financial difficulties. If we go back to when this decision was taken, so at the end of 2023, we also know that the interest rate was through the roof throughout that same period, which has made that this company was forced to cut at different places to lower their total expenses. It is why a few months after the CRTC decision, Bell has proceeded to one of the biggest layoffs of their history by cutting their workforce by over 4,000 employees, and it has also been said that this restructuring efforts and layoffs should potentially continue throughout 2025. All of these news have made Bell lost over 30% of valuation over the past year and over 40% of their total value over the past 5 years. And even if the company has been able to regain some great momentum lately, the recent financial outlook for 2025 that has been reported in their latest earnings report isn't that good looking for the investors, where Bell has been forecasting some quite important decrease of their total revenue and adjusted EBITDA for the next year. From an investor point of view, the company has just announced that they were not only cutting their dividend by over 50%, but that they were also cutting their expectations for the upcoming year. But despite that, Bell CEO Mirko Bibic, after listening to the different shareholders, has recently said that over the past few months, the board of managers decided that resetting the dividend was the most responsible way to address the capital allocation strategy, where essentially the new dividend level allows them to delever and invest for growth. He later confirmed that the company also has no plan to stop investing in their fiber infrastructure, but that they were going to do it at a slower pace. Despite all of the bad news that the company has been facing lately, the board of managers as well as the CEO have all decided to give themselves some big juicy bonuses for the next year, which represents a total of more than $5 million, where about $2.4 million of it goes straight to the CEO. Nevertheless, let's take a look at the different financial metrics. Nevertheless, let's see if the financial metrics are more reassuring and encouraging for the investors right now. The first thing that we can notice is that the valuation of Bell has been quite significantly dropping over the past year, where it has lost about 33% of its total value. But at the same time, since their earnings has been absolutely horrendous throughout that same period, we can see that their price to earnings ratio went from 20 to over 71, showing that the stock at the moment regarding this aspect would be overvalued. However, when we look at the price to sales and the price to book ratios, we can see that these two indicators would be showing otherwise. Profitability wise, we can see that they have had some pretty low profit margin despite an excellent operating margin of over 22% over the past 12 months. But unfortunately, we can see that they've achieved some pretty poor return on equity over the same period, where they've been able to return about 3% on it. Over the past 12 months, we can see that Bell has been generating some revenue of about $24 billion, with some slight diminution year over year in terms of their quarterly revenue growth. But the only positive news that we can see is in terms of their quarterly earnings growth year over year that have been growing by about 50%. The main problem with Bell is the fact that they are quite over leveraged, where we can see that their total debt is about 40 times bigger than their current cash position, which is also making that their total debt to equity ratio is of over 222%. In terms of the volatility of the company represented by the beta on a 5-year period, we can see that Bell will tend to fluctuate about 2 times less than the overall market, with a beta of about 0.67. But over the past 52 weeks, we can see that it has lost over 35% of its total value, while the stock market on its side has gained about 11% of valuation. And here we have the old dividend yield that is of about 11%, while at the moment it is of about 5.70% since it has been basically cut in half. And this occurred because they have an extremely high payout ratio of over 950%, which is showing that the dividend needed to be cut to be sustainable, to be continuously paid in the long term. Finally, to determine what is the true intrinsic value of this company, we'll use different valuation models, starting out with the Peter Lynch one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And even if we take the old dividend of over 11% with the super high P ratio, we can still see that this company would currently be quite overvalued right now. Unfortunately, for the second model, which is the dividend discounted model, since the average growth rate is bigger than the weighted average cost of a capital, we can see that we won't be able to use this model. But for the third one, which is the discounted cash flow model, where we'll simply discount all the future free cash flow of this company to find what is its business value, we first need to find what is the cost of debt, then the cost of equity, and the cost of debt and equity to find our weighted average cost of capital. And with this WACC, we can see that our intrinsic value would be of about $26 per share, which would mean that this company company would also be quite overvalued right now. Finally, the two last models that we'll be using to find what is the true intrinsic value of Bell will be the Graham's original value formula and the Graham's revised value formula. And with both models, unfortunately, we can see that in both cases, they are showing us that this company would currently be quite overvalued right now. As you've been able to see in this video, even if Bell currently has a big portion of the total Canadian telecom market, they might not have the best approach, notably when it comes to their capital allocation compared to one of their big competitors, TELUS. Add to this, even if Bell is still offering a dividend that exceeds over 5% despite the recent dividend cut, the different financial metrics and valuation models are all showing us that this company would currently be quite overvalued, which is one of the reasons why I would avoid this company right now. But on your side, if you're looking for the best undervalued companies that are currently available on the market right now, well, check out the video that's going to be right over here, and I will see you soon. Peace.